Hello, and welcome to Palm Springs Life Market Watch. I'm Heidi Hewitt, Director of Events for Palm Springs Life. Is a normal housing market just around the corner? Let's find out. Our webinar today is hosted by industry experts Michael McDonald of Market Watch LLC and Walter Neal of Franklin Loan Center. Before we get started, we'd like to thank our sponsors of Market Watch: Franklin Loan Center, Renova Energy, California Desert Association of Realtors, and Greater Palm Spring Realtors. With that said, let's get started. Introducing Michael McDonald of Market Watch LLC.
Thank you, Heidi. I appreciate that introduction. We've got a catchy title here: what's hot and what's not. And we did that specifically because this is a very unique moment in time. We've never seen a housing market kind of as stressed as this one is, or a kind of dislocated is the best word, I think. Let me explain a little bit again how this even got started into the current situation. We had back in, it was actually in February of 2020, we were hit by COVID. COVID changed everything. I don't know if people remember, but within about 4 or 5 months at the beginning of that pandemic, we didn't know what was going on. Nobody did. Unemployment ran up to 15 or 20%. That's the highest since the Great Depression. It happened in about 3 or 4 months. We were on course, had the government not done anything, to be in the worst recession, or actually depression, since 1929. So what do? The government came out with a spending program. They gave everybody tons of money. They sent us money. Everybody got money to spend. They wanted to keep the economy going, irrespective of what people, if they had jobs at all. The Federal Reserve Board kicked into gear, and they engineered unbelievably low interest rates. All this stimulation had an effect, the beneficial effect that kept the economy going. Okay, the housing market slumped for a couple of months and then came surging back. So did the economy. And they bridged what it could have been a very difficult period of time. And I was amazed, really, how well they did. Both administrations, plus the Federal Reserve Board, should be applauded for what they did. We came across that without much dislocation. But there are repercussions of that kind of stimulation. They saved the day, so to speak, but there were side effects that had to be dealt with. Over time, all that stimulation created some inflation that suddenly kicked into gear about 1.5 years ago. And we went up to 12% inflation rate. And they suddenly, therefore, had to reverse gears and go to the other side. All these dislocations had an effect on the housing market. The first stimulated it. We had more than normal housing sales throughout 2021, 2022. Then it went down below, and we've been below now with higher interest rates for a period of time. These are normal, expected dislocations, considering what we went through. There's no way you can come through a pandemic like that with all the economic repercussions, no matter how you engineer it, without some dislocations. That's all we're experiencing, ladies and gentlemen. And the question is, what effect has it on housing? And I want to update you with those metrics. That's my job today. Then we're going to bring Walter Neal of Franklin Loan Center to address the very important question: when can we expect all this different dislocations to subside and get into a much more normal housing market, which is really the big question. So what's hot and what's not? I'm going to give you a summary right up front of I always like to do this. Know before you go. I don't want you guessing what I'm going to be saying. I'm going to tell you right up front the summary of the presentation in the very first slide. Then I'm going to show you the information that led to these conclusions. This way, I think you see the conclusion, and then you see the evidence that led to that. That's much more effective than leaving you in a state of where is he going with this talk, and leave that to the very end. I find it much more beneficial to do that. Valley sales, first point, have been declining for over 2 years now and are now 28% below normal. But interestingly enough, dollar sales, because of the increased price of the last 3 years, is up 20% over pre-COVID levels. Even though unit sales are down, dollar sales are about 20% above 2019. And since your revenue is primarily dependent on dollar sales, not so much unit sales, a little bit of both, that we're kind of just back to where we were from a dollar point of view to 2019. So what we had during that period of time was way over normal. We couldn't be held to that standard going forward for a very length of time. But it's kind of to know it's not really as bad as it might seem when you look at dollar sales. 1 in 5 sales are now over $1 million in the Coachella Valley. All the numbers I'm going to give you today are statistics and metrics for the Coachella Valley. Walt's going to show you kind of an international or national point of view because that affects interest rates and the economy, which is what's holding things back. But I'm going to show you all the metrics with regard to Coachella Valley. 65% homes sold over $2 million are purchased by remote owners. There are owner-occupied people or homes in which they're owned and occupied by the owner. Then you have remote owners. Remote owners are either people who own a property to rent it out, or they own the property as a second home. It's generally a mix of that. I would guess in the Valley, maybe 35% of remote-owned property is for rental purposes. 65% are second homes. But 65% of homes over $2 million, and those are generally not for rental, those are second homes, are remote owners. There are now 160,000 homes in the Valley. I'm going to show you not only sales metrics, but housing stock metrics to see if there's been any changes in the last 4 years of the number of houses in the Valley and who owns them. So now there's it's 159,807. So I rounded off 160,000 homes in the Valley, of which 70% are detached, 30% attached. Half of these, almost exactly half, I think it's 50.2 or something like that, are remotely owned homes. In a normal area, it's normally 15% are remotely owned. Primarily, those are rental properties. Here, 50% are remotely owned. That has not changed much in the last 10 or 15 years. 25% of remote owners live in the Valley. Now, how do we determine whether a person's a remote owner or an owner-occupant? It's done in the industry in the following way. You look at the mailing address where all the tax information is sent. If that's the site address or the address of the home, then we assume the person's an owner-occupant. If the mailing address for tax purposes is different than the actual home address, we assume it's a remote-owned property. Now, there are flaws in that. There's no other way to look at it. It's not perfect, okay? In other words, you can get, for example, someone who has a business and has all their tax, even though they live in the home, they have all their tax information sent to their business address or a P.O. box number or something like that. So it's not always true that a remote owner is not an owner-occupied person, but there's no other way to really address that. And there's always that loophole in there. But of that, there are the rental properties. And that's why 25% of the remote owners live in the Valley. Those are not second home owners. That 25% are people who own second homes in the Valley to rent those homes. 19% of the remote owners in the Coachella Valley live in LA County. Those are primarily, could be rentals, they could be, but primarily those are second homes. Excluding California, Washington State has the highest number of remote owners at 7%. 1 in 20 remote owners are now from Canada. It used to be up to 7 to 8%. It's now down to 5%, which is 1 in 20. Inventory remains low because monthly new listings are down 26%. No one wants to sell. In other words, we have a low inventory situation, low sales. Now, normally you would expect with low sales, as new homes come in, as sales occur, normally the replenishment rate, which is the new listings that come in, normally, if it was normal, would be in excess of the sales rate and the inventory would rise. We're not getting that. We're getting kind of a low, stable inventory situation. It should be about 3,000, 3,500. It's around 2,000. It's not coming down, but at that low sales rate, it should be rising, but it's not, primarily because the number of new listings are also down 26%. That's primarily because people have mortgages under 5%. And they don't want to sell that home and buy somewhere else and pay 7.5% to 8%. So that's in the region, it's down 26%. Because of rate buy downs, new homes now account for 17% of all sales in the valley. Used to be on average around 10%. Now it's 17% of new. So you're going to find, until the situation turns around, homeowners are going to be coming, potential home buyers are coming to the region. They're going to be looking to new homes. One, because they get an interest rate buy down on the mortgage. Builders are offering mortgages with a 2% rate buy down. So instead of paying 7.5% or 8%, you're going to pay 5 or 5.5% if you buy a new home. That's enough of an incentive to draw sales away from the resale market into the new home market. And we're seeing that. That should continue and will help relieve the pressure on the inventory. Okay, now let's get into all the facts or the data that led to these conclusions, okay? The first one, valley sales have been declining since July of 2021. Biggest decline is in attached homes. Now, what is this? This goes back to 2018, September, March, all the way over to September of 2023. So we have really, what do we have here? We have 5 years of time. It's actually 6, isn't it? 1, 2, 3, 4. No, 5 years. Okay, 5 years of time. And what we looked at is September sales. It's 12-month average. Back in September of 2019, that was right before COVID. And we had total sales on average per month over a 12-month period, averaging around 804 units per month. Now it's down to 573. So down here under the total, 2019, 804. Now it's 573. Total sales of detached and attached is down 28.7%. Now it's not equally spaced. In the attached market, we're down 33%, a detached 26.3. Again, the total 28.7. So that, and you can see here this drawdown. We had this spike in sales during COVID. And then as COVID disappeared and they took the stimulation away, we've been having detracting sales here for almost exactly 2 years, okay? So on to the next. Now, this next chart, I want to explain. It makes sense if it's explained correctly. This is in your monthly report that we do for both boards. And what do we do here? We wanted to see one of the problems with the Valley, it's so seasonal. If you look at sales, you think sales are down this month. Is it down because of seasonal factors, or is it down because real sales are down? So it's difficult to compare how things are today. You always have to compare it with, for example, right now, September, October. You would compare October sales against October sales pre-COVID, because COVID kind of made everything kind of go up and down a lot. You can't look at that as the norm. So pre-COVID, what we took is 4 years, 2016, 17, 18, and 19, and we looked at average sales in those 4 years for each month. Okay. Then we compare sales today again in that month today. For example, October, the last one data we have here is September. No, this is for October. I'm sorry. The latest data is as October. We took sales for October and compared it to the average of the 4 years before COVID for October. And when you do that, we're now down 27% below normal. And this shows you the whole picture, that we did this all the way back 2020. And you can see COVID, that we went below normal by 30%. Then as they stimulated the economy, we went up to the point where we're 60% sales. These are unit sales above normal. And that was by January 2021. And since then, we've been slowly coming down. And by mid-year, last year, 2022, we went below normal. Now, we can look at this in a number of ways. One way is that this is the average line. Ideally, you would want to be right along that line with a little bit of growth factor just due to the things getting bigger. Of course, you don't. And this, we had a number of sales pushed forward during the COVID period due to all that stimulation. Now, effectively, we're going to suffer the repercussions of that. Assuming everything adds up to zero, if you push for sales ahead for, let's say, a year and a half, you're going to have to come under that normal so that you average that this black line here. We're in this this period here. We have to kind of digest all that excess sales that occurred during the COVID period. And we reached a low. We're not back as low as it got, which was in the beginning of this year, when we were down almost 35%. Now we're down 27. We had hoped that this was the beginning of the recovery. It wasn't. But this tells you where we're at. Notice it matches almost how far sales was down. What sales were down 28.4%, I think. So on the seasonal metric, we're down 27.7. So you get from two different sides the same conclusion. We're off around 27, 28% below normal. Okay. That's unit sales. Dollar sales were okay. So now let's take a look at, here's the dollar sales. And here is normally back before COVID, we sold on average 400 million sales, dollar sales per year. Here was COVID. Right now we're at 489. We're still above the norm. And that's why we say we're 20% above pre-COVID levels in dollar sales. Now let's come to the next one. Oh, there we go. Valley shifting sales pattern. We took a look at the, we broke sales down by price bracket. Notice each one of these is a price bracket. Home selling for under 300,000. This bracket is between 3 and 400,000. This between 4 and 5, between 5 and 6, 6 to 7, 7 to 8, 8 to 9, 9 to 10, million to 2 million, and over 2 million. So these are the price brackets. And what do? We look at current sales, which is this dark color. What percentage of housing sales occur in homes under 300,000? Now it's 6.7%. Before COVID, it was 33%. So notice that that the current number of sales in the higher price brackets are higher than they were before. Okay, you would expect that because they're higher priced homes now. Everything moved up. The interesting part here is that if you take the $1 million and over homes, 14.6 and 5.4, that's 20% of all homes sell over. That's 1 out of 5 sell over $1 million. 1 in 5 homes now sell for over $1 million. Prior to COVID, it was 1 in 14 sales. 50% of homes sold are now over $600,000. Okay, before it was under $400,000. So this price increase the last couple of years has shifted the sales pattern, the price bracket of the sales pattern, definitely. Now, let's get into the next one. We looked at sales by price bracket again, but by owner type. In other words, remember we have the two owners. We have the remote owner and we have the owner occupant. Now we're going to look at sales. Did that sale occur by a remote owner or was the sale by a owner occupant? Okay, here we have the total numbers. In the last 12 months, there was just about 7,000 home sales. Of that, almost 52% were owner occupied. Remote owners were 47.8%. So 52.2, 47.8. Now, you don't know this yet, but later on, I'm going to show you a slide. If you look at the housing stock, this is sales. I just showed you sales here. If you look at the housing stock of the 160,000 homes, and you look at the percent, I already told you what it was. So it was about 50-50. So we're finding that the sales, or the question one might ask is, are we getting more sales from owner occupants than normal, or are we getting more remote owners selling than normal? These statistics tell us that everything's okay. We're getting the normal number of owner occupants buying and selling, and the normal number of, or the ratio that matches the housing stock, remote owners. So there's nothing getting out of whack or disproportionate in what's selling in the valley, which is good. That's healthy. Now, we kind of diagrammed that. We broke this down. We looked at what percentage of sales are remote owners. Remember, this dark line is remote owners, and this light line is owner occupied. Notice that most of the lower mid-price brackets, you have lower number of remote owners, higher percentage owner occupied, and it's the tail end of the price brackets. The $1 million and over homes, you have higher percentage of remote owners. As I mentioned, 65.3% of all homes sold over $2 million are remote owners. And down here at the lower end, why is this one higher at the low end? Because so many condominiums are remotely owned, and condominiums are at the lower price bracket. So you're getting here exactly what you would expect to see. Nothing abnormal there. Okay, so things are healthy. Changes in Coachella Valley housing stock and ownership. We got this data from the Riverside County Assessor's Office. Latest housing numbers, there are 160,000 homes in the valley, 70% detached, 30% attached. Half of these homes are remotely owned. These are the numbers. Now, what we did is compare them against 2019. The latest number is here's the 159,890. That's 160. And the percent that is detached, the percent attached. And then we had the number in 2019 and the difference. So we've really added, since 2019, we've added 8,000 homes because the housing stock used to be 151,700. Now, again, it's 160. And we've added 8,000 homes. Almost all of those are detached homes. We're only building 10% of the homes being built are attached homes. This is not the way it was back earlier in, for example, 2000. Now, percent remote owners, this is rather interesting. In 2019, 50.7% were remotely owned. 2023, 50.8%. There is absolutely no change in the percentage of remotely owned homes in the valley of the housing stock. So there's been no unusual overbalancing of homeowners coming into the region, either remote or owner occupants. Everything as it is, as it should be. Now, the percent that went detached is a little bit higher. We have a slightly higher number of remote owners who are detached, own detached homes, slight fewer attached, but the differences are not enough to really cause anybody to think about it. These are could just be random fluctuations. Okay, so now housing stock by city. We break the numbers down by city. I look at single family residences. What percentages are remotely owned there? We rank these by the percent remotely owned of single family homes, detached homes. The largest percent is in Indian Wells, where you have 66% of all detached homes are remotely owned. That's 2 out of 3. Okay, of homes in Indian Wells are remotely owned. That's why there's not too many people who are in those homes all the time during the hot season. They go vacant because they're second homes primarily. Palm Springs is 57.7, La Quinta almost 50%. Over here, condominiums. Now, condominiums, almost 3 out of 4 condominiums are remotely owned. Of the total of all the condominiums and PUDs in the Coachella Valley, of the 38,339, 76% are remotely owned. Of the bigger cities, Palm Springs has the highest number. 84% of condominiums and PUDs in Palm Springs are remotely owned, followed by Indio at 80%, La Quinta 78%. So condominiums, the overwhelming ownership is remotely owned. So now, by home type, housing stock by city, where do they come from? Where do the remote owners come from? Locational remote owners, percentage of remote owners by city. Now, we took a look at what percentage come from, for each city, come from the Coachella Valley. What percentage of the remote owners come from LA County? What percentage Orange County, San Diego County, San Francisco County, Colorado, Illinois? There's a reason we picked these states, by the way, because we know beforehand that these are the greatest number of remote owners come from these states: Colorado, Illinois, Minnesota, Oregon, and Washington. Down here, notice 6.8% of remote owners come from Washington. Here's the 19.1% from LA County. Orange County is 8.7. San Diego is 4.2. San Francisco 1%. Colorado is 1%. Illinois is 1.4. Minnesota 1.2. 5% of remote owners are from Canada. So this gives you a breakdown of the region and which cities the remote owners come from. Now, Inventory, Coachella Valley inventory of homes. Okay, here's the latest number. Notice it's 2,100 here. It's jumped in the last couple of months, but we're still below the norms. We should be around 3,000. So even though inventory sales are down, inventory is not growing. And the reason is we've talked about is because primarily no new listings. Listings by city. Okay. And notice here we've got the number of listings. And this was the latest listings, by the way. We take the number of owner. What we do is we take the listing of all the homes for sale and determine, is it being listed by an owner occupant or by a remote owner? And that's what these numbers are. Bermuda Dunes, for example, has a total of 25 listings. 19 are owner occupied. 6 are from remote owners, meaning that the percent is 24%. Cathedral City, 44.8% of its listings are remote owners. Coachella, 56%. Desert Hot Spring, Indian Wells, 66.7%. You would expect because of the high, that's almost matches exactly the housing stock ratio of remote owners. Indio, 39, et cetera. La Quinta, 40. Over here, we have the similar numbers here. And here are the total. 44% of all the listings are remote owners. Over here under the condos, you would expect this to be 75%. It isn't, it's 54%. We're not sure why the percentage of listings of condominiums are more from owner occupants than remote owners, but it is. We noticed it last 6 months ago also. So listings of attached homes by remote owners considerably less than their ownership of attached homes housing stock. Should be 75%, but it's lower. The listings are coming primarily from owner occupants. Listings of detached homes by remote owners is in line with its ownership of detached housing stock. In other words, this ratio of 44% is real close to what the ownership rate is of remote owners in the detached housing market, okay? Now, finally, this is the one that I wanted to bring your attention. Monthly new listings are down 26%. This is the key to inventory. Why are people not listing? First off, what is this? This goes back to 2016 all the way to 2023 here. This is the latest number. This is the average number of new listings per month in units. Notice we used to average around 1,270 before COVID. That would be the normal average per month. And we maintain that, came down, and it's sinking further and further. Fewer and fewer people are listing their homes. Why? Because we've mentioned it before, we'll mention it again. They have 5% or 4% or 3.5% mortgages on their current home. They're waiting. If they do want to move, they're waiting. They do not want to sell a home that they're paying 3.5% or 4% interest on and buy somewhere else, even though they might want to move. They can't move and be true to their financial feelings about things. They're waiting, we believe. They're waiting for things to come back down again, where it makes sense for them to give up that low mortgage rate and buy a place somewhere else at a relatively low mortgage rate. Rethink if it comes back to 5.5%. That'll be low enough then to trigger a surge of new listings, which we think will happen once we get back to normal, okay? So final curve, this is the percent going back to 2000 of the valley. Again, this is all valley numbers. The percent that of new homes, of total sales attributable to new homes. Before, back in the 2000, during that bubble period, we were up to 25 to 30% of sales were from new homes. Normal is down about 10%. We're now to 17%. These are the numbers by city. So again, this is due to the fact that people get these rate buy downs and they can get a 5% loan if they buy a new home. So they are willing now to move when they wouldn't if they maybe had to pay 7.5% or 8%. So that hopefully gives you a view of what's going on in the housing market in the region. We already know what's going on price-wise. Things are relatively stable. I didn't want to go over too much information. I wanted to bring up to date the ownership qualities, if there's been any change in ownership, if there's been any change in the sales patterns of the region. There aren't any. So things are kind of going as you would expect them to go. The question is, when is it going to shift? And for that question, we're going to bring up Walter Neal of the Franklin Loan Center to talk about that aspect of it. So, Walter, please take it away.
Michael, tremendous job as always. You do such a great job putting facts and information onto slides that we can all understand and use in our careers. It's a shame we can't be in person to do this today, but the one good thing we did get out of COVID is that the virtual meetings are more acceptable, and we have a sold out event. And so it's an opportunity for us to still reach out to people that cannot make it to the event without having available seating, that they can still get the information. So fine job, Michael. And I will jump right in here. I can tell you all that I spent a lot of time putting together these presentations because I want them to be of a value add, and I want them to be information that you can hold on to for encouragement and use with your buyers and sellers so that your greater and your best days are ahead. So a couple quotes to start out my presentation today. Make today so great that yesterday gets jealous and tomorrow waits with anticipation of your arrival. Such an amazing quote. Enthusiasm is the force that creates momentum. So we can all use a little more enthusiasm right now because momentum is a challenge, but we will get there together. And the last is fear. Fear is one of those words that I think everyone encounters it. Everyone feels it, sometimes hourly, sometimes daily. I want to give you two analogies or acronyms for fear. First is false evidence appearing real. So today we're going to talk about real facts because there's a lot of people out there that see false evidence appearing real, if it's on TV, if it's something they're reading. And the last is probably my favorite acronym for fear, and that is face everything and rise. And that's what we've all done here as an industry, and we will continue to do and succeed together. So as Mike does, I'm going to give you a quick summary of the things I'm going to be talking about today. And then I'm going to dive into these in more details and talk around these topics and some other ones. The first one is inflation. Obviously, right now we have a war on inflation. And we have to stop inflation at all costs. And that is what the Fed has done. And that has had an effect on interest rates as well. So we're going to talk about what's happened in the past, what we see forthcoming so that you can forecast the future. You can forecast your business moving forward. I'm going to talk about recessions. Recessions are natural. They happen. They're good for the economy. I'm going to give you some recession indicators that I think are very accurate and that will predict a recession to come. We're going to talk about real estate perspective. Perspectives because I'm going to go in a deep dive in 70 years back on real estate. And then I'm going to talk about an appreciation picture currently moving forward. I think that information will be very valuable for you guys to have rebuttals to buyers and sellers out there. Inventory dilemma. Michael's talked a lot about that. I'm going to talk more at a national level and just basic supply and demand, common sense issues. And then I'm going to close with some buyer, seller / realtor tools that I think are very helpful in this environment. And I'll get into those three things at the end of the presentation. And then hopefully next time around, you guys can make the event in person, but we're glad to be able to do this at least virtual today. All right, so I'm going to start with two screens here. Two charts here. The top of the chart is the federal funds rate, and the bottom of the chart is a 30-year fix. And the reason why I wanted to put two charts on one page is because the direction of the Fed funds rate, as well as inflation, is a direction of mortgage rates. And so you can see a very clear comparison. This goes back to 1955, the current, and this also goes back to about 1976 here in the bottom of the 30-year fixed rates. So if you look at them side by side here, they move in tandem. Most recent, you can see the huge increase in Fed funds rate. The Fed increased their rate from basically 0 to a quarter. It was always within the range of a quarter. So currently where it stands at 5 1/4, 5 1/2. So they increased rates 11 times over the last year and a half. And that's had a dramatic impact on a lot of areas we'll talk about. And obviously one of those areas is interest rates. You can see it right now, how dramatically these interest rates have popped up here, getting all the way up to about 8%. So when something only happens 5 times in the past 40 years, I think it's something that's worth paying attention to and recognizing. And what this chart here is the blue line is the Fed funds rate. And by the way, on all of my charts, anytime you see a shaded line on the charts, that means that's a recessionary period. The Board of Economics, who control calling recessions, and they normally call them after they've happened. So for instance, if we're in a recession now, they might call it in the summer or or fall of next year. Okay. But you'll always see these. I think it's very important to see trends based on data and trends based on what's actually going on in the economy to predict recessions. And you can see only 5 times the Fed funds rate was more expensive than the 10-year treasury. Okay. The Fed funds rate is what banks borrow overnight from each other and the Federal Reserve. So that's basically short-term lending, 24 hours overnight, right? 10-year treasury yield is when you buy a bond and you receive income for 10 years. So you would think a 10-year bond would always have a higher rate of return than borrowing money overnight. Well, that is the case. But when you have a sick economy and the economy is not doing well, then sometimes long-term money can be more expensive. Short-term money, you can see 5 different times the Fed funds rate, because of the Fed's aggressive policy, moves so quickly. 11 rate hikes in the year and a half. Fed funds rate most currently was the 5th time in the last 40 years that's happened. And the previous 4 times happened recession. So right now, this is something that we're keeping an eye on. Like I said, history is very important. It doesn't always repeat with the future, but it always rhymes. So that's something we're going to keep an eye on. Okay, the Fed, when it increases the Fed funds rate, it also increases the prime rate. And the prime rate is very similar to what the mortgages is for people who take out mortgages, but prime rate is what people borrow in business. Okay, it also affects credit card balances, credit card interest rate. So the prime rate, if businesses are borrowing money on prime rate, and prime was at 2.5% a year and a half ago, and now prime rate is up to 8.5%, it's going to be harder for businesses to create products and services. And if they can't create products or services, it's very difficult for the economy to flourish. So this is a tactic that the Fed is purposely doing. They're trying to slow down business. They're trying to slow down services. They're trying to slow down products, and so that the economy will slow and inflation will drop. Okay, but the problem is if these rates stay too high too long, it'll break businesses. And if you break businesses, you don't have products and services. So the good news is we think that the Fed is at the limit or the peak of their tightening policies, and they're going to start lowering here. And so the good news is I think prime has peaked, and businesses should get some relief here in the coming months. So that's a very important thing to understand about prime. All right, so inflation. That is right now the number one thing the Fed is focused on and trying to defeat. And if you see here, this this green line, that's interest rates. And the blue line is a CPI index, which is a value of how if goods are costing more or less. So as the CPI index goes up, goods are costing more, it's more inflationary. You guys see it with food right now, right? And as inflation goes up, rates normally go up. So you can see inflation went up, rates went up. Inflation went down, rates went down. Inflation went sideways, rates went sideways. And you can see here that you have CPI, you have inflation going up, you got rates going up. So they always go hand in hand. But right now, one of the few times in history, you're actually seeing mortgage rates continue to go up or stay flat, and inflation is going down. So a lot of people are concerned about why is this happening and why have rates stayed higher for longer. I as well as everyone else, did not see rates staying this high this long. The Fed themselves said by this time, a year and a half ago, that the Fed funds rate would be 2.5% to 3%. Well, the Fed fund rate is 5.5%. So no one really called rates staying this high this long. But the good news is there is relief to come. So I want to explain to you why this occurrence is happening right now when you see interest rates still improving and inflation coming down. Okay, because inflation coming down, right now, housing is 43% of inflation, but rents are coming down. Gas is coming down, so inflation is coming down, and the Fed is trying to get to a target of 2% on inflation. But if you actually don't look at the CPI as a lagging index, the problem with the lagging index is it's a lot like a roller coaster. Okay, the front of the roller coaster is where we are today. The problem with this index, the CPI index, is it's not looking at the front of the roller coaster; it's looking at the back of the roller coaster, and it's averaging the whole roller coaster. And what we really should be worried about, the Fed should be, is what's the last 90 days look like. So when you have a lagging index, it can sometimes set up false alerts and give the Fed momentum or encouragement to do things that they shouldn't be doing. So why are the rates so high and inflation starting to come down, getting closer to the Fed's target? Well, typically, if you look at the spread between a 30-year mortgage and a 10-year bond, and you go back here, we'll go back 25 years, you can see that the spread between the 10-year treasury yield and a 30-year fixed mortgage is normally somewhere between 1.75% and 2%. Okay. But look where it's been here for really the past year. The spreads increased from 2% to 3%. So the Fed funds rate is 5.25%, which it is today. Typically rates should be 7.25%, but they're not 7.25%. They're 8.25%. Okay. And the reason why they're 8.25% is there's something called servicing value on every loan. Every loan that gets taken out ends up having someone who services. It's sort of like the accounting firm of bonds. And those individuals collect the money and pay it out to the bondholder or the person who bought the investment. Well, right now, no one believes interest rates are going to stay high long, and all of those mortgages, okay, or bonds, treasury bonds as well, they are probably going to sell or refinance moving forward. And so because the servicing value isn't there, that is why, and I've been in the mortgage business 23 years, and I think the first 21 of them, it was very rare to see a client pay points on a mortgage unless they wanted to buy the loan down aggressively. Well, in the last 18 months, no matter if you have perfect credit with 30% down, you're still paying points to get a loan. So the market shifted tremendously over the last 18 months because the servicing value of loans are gone, because no bonds are expected to stay outstanding when rates come down in 2024 and we have a refinance boom. So that is the reason why a lot of your clients and your friends are paying points and getting higher interest rates. This is a topic that Mike brought up briefly, and I kind of wanted to talk about these buy downs because there's a lot of people out there that think these buy downs is a saving grace for the real estate industry and the mortgage industry, and it's really not. So this top line here, this is from June of 21 to 23, and this right here is the monthly average 30-year fix, and you can see how aggressively it went up. And look at that. If you went back a couple of years ago, buy downs were like never ever used, really like 0.5%. And when these rates increased so much, builders more than residential resales started using these buy downs, and it really jumped up in popularity. And a lot of people started to use them. Like I said, mostly builders, even some resale transactions. But look how it's died down. It's died down for a couple of reasons, because people are now getting more used to the higher rates. And a lot of people are now expecting for rates to come down, and they're not going to pay a bunch of money to buy the rate down if they can refinance it in a year. And so that's a sort of a chart for you on these buy downs. Like I said, it's great for new home construction, but it's not really great for the resale market. Affordability concerns. There's a lot of concerns out there about affordability. Right now, the average median home in the country would take you about $115,000 to buy that home. And the average earnings for an individual is around $70,000. So an individual, one person is going to be challenged to be able to affordably buy a home in this market. If they're married and you have two $70,000 salaries, you got 140, then you guys can easily qualify, and affordability issues do go away. But there are some concerns about this. You know, there's another chart with slide we'll talk about in a minute, but not everyone is actual buyer. 64% of everyone is a home buyer, and 36% of everyone is a renter. And so when it comes down to affordability concerns, a lot of it doesn't really fall to the people that typically are renters. It falls to the 64% that are buyers. So this is something we'll continue to keep the eye on. But affordability, before I move from this page, income wages are up in a lot of industries. Maybe not real estate and mortgages right now, but in a lot of industries, people are making more and more money. And so you don't have to increase your income by as much as the home. If home goes up $10,000 in price, your income only needs to go about $2,000 a year. So affordability is actually better than a lot of people want to give it credit for, but it is something that is definitely peaking. Housing stays strong through recessions. For anyone that comes to these Market Watch seminars, I've been doing these. I think this is my 7th year doing these seminars. We do 3 a year. I use this slide all the time. I think it gives great perspective, because a lot of people think that a recession is bad for everything. Well, a recession is not bad for real estate, and recession is not bad for interest rates, and a recession is not bad for more listings and more transactions, and more buyers. So if we're all in a transactional business, a recession might be actually good for what the market we're in right now. And so what this is the white line here is the Case-Shiller Index. It's the gold standards for predicting the whole house prices throughout the country. And then all these shaded lines again are once again recessions. And you can see that every recession, real estate values went up, except the one in 2007 to 2011, the Great real estate bubble recession. And so just because a recession may be coming or looming, it may slow down the appreciation of homes. They might not appreciate as aggressive, but they'll still appreciate more than going negative. And so this is a very important concept to understand. And there's a lot of people that will argue this, and they probably can be accurate if you're looking at a just one market. There are some markets that don't fare as well as others in recessions, but if you look at the whole enchilada together, real estate does fine through recessions as long as you're in the correct area and the supply and demand doesn't get out of kilter. That can happen in small niches, but overall it does not. Unemployment rate in recessions. Okay, so this is really the last indicator that we've been waiting for the trigger, and everyone now has triggered now that the unemployment rate has increased. They came out with the numbers last week. That was one of the reasons why we got a boost in interest rates, lowered about a quarter to 3/8 in rate. So now we're down in the mid to upper sevens, still with points, but the rates are now, they have a 7 in front of it instead of an 8, and it came out with unemployment numbers at 3.9%. Okay, the reason why this is so important to track, once again, this goes back to 1949. All these shaded lines are recessions. And every time unemployment bottomed, meaning it starts to go up, that means you're going into recession, because the number one cost for any business that's providing products or services, small to big, is labor. And the number one thing you've got to get rid of, if you're slow, you're not producing widgets, you're not producing services, you have to get rid of people. And when you get rid of people, it saves you money. And so as you see the unemployment rate start to rise, people are getting rid of labor. And that's an indicator that the economy is not doing well. So every time it bottoms, recessions, bottoms, unemployment, recession, bottoms every single time. Okay, it bottomed. There's the last recession. And look, it's bottomed at 3.4, and now it's up to 3.9. That's a 0.5% increase off the lowest number. And why is that important? Well, let me show you a chart here. This is unemployment rate based on recessions. Okay, and this goes back all the way to 1948. And basically what this first column here is the low of unemployment. So I just mentioned on the previous screen that we were at 3.4% on unemployment about a year and a half ago, 3.4%. It's now rised 0.5% higher in October 2023, just came out last month. So whenever in history we've gone 0.5% an unemployment higher than the low of that period, every single time we've gone to recession. And this is how long it's taken. Last time we did it in February 2020, okay, it was at 3.5, and then March 2020 was up. And we're in a recession immediately. May 27th, May 2007, it was at 4.4. In December 2007, it was up. We're in a recession in 1 month. Okay, this one is how do I get back here? Backspace. There it goes. This one's -2, because once again, sometimes you're already in a recession when these things trigger. Sometimes it's in the future. The longest period we ever went was 9 months back in January 1948 and March of 1948. And so that was 9 months. So the question is, when is the next recession going to be actually announced? We won't know until next year, but we could easily be in it as we speak. So hopefully that you guys understand that point. And this is another recessionary trigger. And the reason why I'm spending so much time on the big R word is because this big R word is actually what we all need in the mortgage industry, in the real estate industry, to have this market turn. And this right here is a chart on the 10-year Treasury bonds minus the 2-year Treasury. Okay. And whatever the yield is. So if you can take out a 10-year bond and you get paid 5%, and you take out a 2-year bond and you get paid 6%, you're getting 1% more to lock your money in for 2 years and getting 1% less to lock it up for 10 years. So that makes no sense. No one would ever do that. And so typically that only happens when the market is unhealthy. And every time in red is when we've had the 2-year money more expensive or paying you more money than the 10-year. And so every single time we've been red, a recession has followed. Okay. And look, we've been in red now for a while. There's only been 2 other times that we've gone this long in red without officially showing a recession. So we are long overdue for that. But the good news is it's going to be a soft landing recession. I'm going to give you a lot of reasons why today, but this is another great chart. And it's actually should give you hope that transactions, lower rates, inventory will all be coming to this market. Okay. Well, what else is going on right now? Well, everyone's hearing about the fact that credit card balances have gone up so aggressively. So this goes all the way back. This bottom one here is credit card balances, $760 billion. We've now toppled over $1 trillion of credit card debt. That's up $270 billion in the last year. And one of the negatives about this credit card debt, I talked about prime rate. Prime rate controls credit cards, interest rates, also car loans. It was at 14% for the average credit card. Today, it's at 25%. So those individuals that are drowning in debt, it's only getting worse for them as the payments go up. And then, unfortunately, not only is there a lot of credit card on the rise, but you can see this period right here. This is the period Mike was talking about, our last recession, where the Fed came in and the government and spent a lot of money, put a lot of money in people's hands. And look at the savings rate. People were saving a lot of money through all that stimulus. But since the stimulus has stopped, savings have come crashing down. So right now we've got a lot of individuals with not a lot of savings and a lot of credit card debt. And you might say to me, "Oh, wow, that's horrible." And I said, well, there's actually a silver bullet here for about 64% of those people. Okay, but another thing to touch on, the average car right now to buy in the country is $48,000, and the average car payment's $1,044. So major inflationary pressures on the car, and HELOCs, which is a lot of people are going to be grabbing to pay off debt and survive. Unfortunately, because prime is high, okay, and HELOCs are based on prime. The average HELOC right now is like 9.5%. It's actually a really good deal. So most of them are in the tens. So something that's definitely that we need to be aware of, but know that there's, the only way out of this is going through recession with lower rates and keeping real estate values high with supply and demand staying intact, which it will, and I'll talk about that. So I talked about household savings being so low, and I did talk earlier about, I said 64, but 66% of all people are homeowners, so 82 million individuals own homes in the U.S., 42 million, which is 34%, rent homes in the U.S. Okay. But the thing I want to get across today is that household savings right now, there are 59% of the people out there, 73 million people that have less than $10,000 in household savings. The next bucket is 25 million, or 20% of the people that have household savings between 10,000 and 100,000. And then if you add this up, you get 14 plus 4 is 18. 3 is 21. So you basically got 21% of individuals here who've got significant savings. And I'll almost guarantee you that 21% of people are falling inside this 66%. Okay. Most likely this 20% as well is in this 82 million, because right now there's a lot of equity in homes. And I'm going to get into that, but it's kind of a great visual to be able to break down 82 million homeowners, 42 million rentals. So sometimes people are always going to be renters, and sometimes people are always going to be homeowners. We obviously want everyone to have the ability to buy a home, but sometimes people have to put themselves in position to be able to buy. So this is a really positive note. And this is one of the reasons why I think we're going to have a soft landing. I'm going to go back to 2008, and this is the average loan to value. So average loan to value is the number based on how much you owe in your home and how much your home is worth. Okay, so in 2008, if someone had a home worth $100,000, they owed $81,000 on it. So they only had $19,000 of equity. Same home in 2011, the average loan was 73% of that. So this individual has $27,000 of home equity. And then it got better in 2013 on $100,000 homes, that'd be $38,000. And look where we are today. This is Black Knight, which is a major component of gathering data and putting out information and statistics. 42% loan to value. So on a $100,000 home today, there's going to be $58,000 of equity compared to $19,000 of equity 15 years earlier. So this equity is going to play a major role in the reason why this will be a short-lived recession. And I don't think it's going to be impacting real estate values at all. And I'll get into that as well. Here's a good reason to why there's not a housing bubble. This is something, if you go back and you look at 2006, this is homeowner vacancy. So these are homes that are people that were living in that are vacant. So like a lot of second homes. And you can see there was a lot of second homes that were just vacant, or primary even, that they couldn't get renters to. And look, today, the vacancy rates are really, really low. Okay, the lowest we've seen, this goes back to 1985. So there's not a lot of homes that are vacant, and rental vacancy rates are also at an all-time low. So there's not a lot of that phantom inventory that's going to come. People love to talk about the VRBO, phantom rental income. I mean, guys, it's just a bunch of noise. and it's not going to come to fruition. And so this is a very important two statistics to understand in this market, that if you saw these numbers up like you saw here in 06 and 07, I would be a lot more concerned, but there's not a lot to be concerned about with these low factors on both of these charts here. Michael talked about this active existing home listings. This is nationwide. You can notice it's very cyclical. Every January listings go up. They went up this January. They went up this January. They just fell down all the way through here. Up this January, and up again this January. So you see listings coming to market in January. That's going to be no different this year. I don't think it's going to be a huge pent up demand of a ton of inventory coming this January because rates aren't going to get to where they need to get that pent up demand seller to sell, but they'll get better and you'll have some. And I do think by the following year, we'll see a little bit more inventory, but we can talk about that in future presentations. Okay, market heating up. Okay, and I think there's a lot of individuals who may argue this, but once again, these are national averages. This first chart over here looks at the percentage of homes that go bid over ask, which means people are going to pay more money for them than what the seller's asking because there's competition for them. Well, you can see right now, almost 30% of every home is being sold above list price. And why is that happening? Well, because there's an average is 2.6 offers on every home right now nationwide. Once again, there's pockets in their markets. Super high end, you might not see this. Super low end, you probably see it because you can't find that kind of affordability. Middle of the road, I think that's there. So I do think there's pockets in prices that can be different, but this overall is what's happening in the U.S. And we don't see this. Maybe there's 0.6 left offers coming in over the next 6 months to a year. Maybe it's 25% bid over ask, which I'm going to get into how we can help you with that bid over ask and help people to actually make a decision to pay over ask price, because it can be very important and be a decision they should be making. So this is something to keep in mind and be aware of as well. Okay, home prices turning higher. If you see the screen down here, all times high reading in real estate values, what I've listed here are the top 5 places that actually predict and forecast of real estate values and puts out numbers monthly. I've got the Case-Shiller, which is, in my opinion, the gold standard and been the most consistent and have been the most accurate. You got FHFA. This is a index that is based any loan that's done on a government loan. Fannie Mae or Freddie Mac, which are like 72% of all the loans. It tells you what those prices have done, if they're going up or down. Then you got CoreLogic. You guys all heard about them. That's a data center. Black Knight, another data center, and Zillow. All these indexes you should know by name. And every time you see green, it set a new all-time high record. Okay. Now, I should say, I know CoreLogic's got a forecasting. They're expecting the fourth quarter of 2023 to be maybe only up, 0.2 to 0.6%. They're expecting it to cool down, but not go negative. Okay, Zillow's actually put out and said this September that just came out, but their number, they said it went down 0.1%, which is why it's no longer in green, because now that's no longer an all-time high forecast for Zillow. But if you look at the year-over-year forecast right now, they're anywhere from 2% to 5.6. If you just look at the year-over-year, which is going back to September, August of last year. But if you look at the 2023 pace, okay, which we don't have the last quarter of 2023, if it keeps this pace up, then you're going to see anywhere from a 6 to 8% return. But look back here in January. You can see in January, we had a negative number of Case-Shiller, negative of CoreLogic. We had a big negative for Zillow. We had a negative for Zillow again. Okay. And we've been pretty much in the positive since March, because we did have a peak in June of 2022, late June of 2022, values came down a little bit and they came flying back up. So this is a very positive picture for housing. I do think things will cool, but I do not think things will go negative appreciation. I just think maybe instead of seeing 0.5 or 0.4, you'll see 0.1 or 0.2. Okay, this I'm really excited to share with you all, and this is called betting against the champ. For those of you who gamble or those of you who like statistics, if you want to bet on real estate and you do bet on real estate, you would have been right 73 times. And if you bought real estate and bet on real estate, you would have been wrong 7 times. And then 1 year was a push. 1 year was a break even. Okay. So let's look at a couple of these periods. This chart goes back to 1942 to 2022. And it shows in here, this is based on Case-Shiller, okay? It shows the average return on real estate nationwide over those periods of years. So let's look at history. 1943 to 1947, okay? Prices were up 118%. So I promise most of you in this room would have been like, oh gosh, 1948 is going to be a correction. Prices are going to come flying down. Well, guess what? That actually didn't happen. The prices went higher for 43 straight years after seeing 118% incline or increase. All these green years all went higher. So you've actually had 43 years, and then you have to add in these 4 years, okay? Let me give you another period. You say, oh, well, that was so long ago. Who cares about that? Okay, so let's look at this period right here. 1974 through 1979, prices went up 93%. Oh, I'm sure there's going to be a correction. I'm sure 1980 is going to suck and no one's going to buy real estate and you shouldn't buy, you should wait, which I'm going to show you why you shouldn't wait later. Well, the prices went higher for 10 years after that period and only go down 1% in 1990 and be flat in 1991. Okay. And then with another consecutive 14 years of positivity. But the reason why there are naysayers and the reason why people are negative, okay, is because they still remember 2007 to 2011, which was the only time values went down in a recession. And it was a very, very painful time. And I don't undervalue that for anyone who's owning real estate. And it's something that a lot of people remember for the rest of their life. But look, you had that bad period of time. But then since then, everything's been pretty solid. And look at the last 3 years, 29, 35% up. Okay, there's a lot of people who think housing bubble coming. No, there's no housing bubble coming. So I want to give you another perspective here. Everyone focuses on this 2007, 2011. Well, there was a reason why that happened. Okay, you've got two lines here. You've got blue, which is household formations. That's when your children leave the house and they either go buy a home themselves or they rent a home. That's a new household formation. Or they get married and buy a home. That's a household formation. Okay, and the orange line is completions. These are new homes being built. Okay, well, let's go back to 2007. Completions. Look at all the homes built in 2006, 2007, 2008, 2009, 2010, 2011, even 2012 and 13. Okay, and going back to 05, from basically 04 to 2014, we built more homes than we had household formations, and household formations are the ones who buy these homes. And so we talked about household formations. Let's talk about inventory. Well, what happened in 2007 with inventory? Well, we had 4 million homes, okay, overbuilt and not enough household formations to buy them. And I'm going to tell you why the household formations fell here in a minute. But look where we are today, 2023. This is nationwide, 1.80 million homes. So we don't have an inventory issue and we don't have a demographic issue anymore. And why do we not have a demographic issue anymore? Because the reason why we had a tough 5 or 7 year period there. If you went back 33 years, and so the average homeowner, new household formation buying a home was 33 years old. So going back 33 years, this is where we were. Okay, right here, 1973. Well, look at the amount of people being born these years. Down, 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 a little up, a little up. Look at this trough. If you go back 15 years, or I'm sorry, 21 years, you go back, we had a lot of household formation because we had a lot of people being born. This is U.S. births by year. Well, we're right here now. We've gotten through this trough, and look what we've got here. We've got literally 40 years of household formations coming up. We have a couple little drops, but not like this big hole we see here. So real estate, we're not going to be able to build homes quick enough to meet the demand. Real estate's going to continue to thrive and do well. And so it's always a good time to buy real estate. So having said that, I think I'd like to help give you all some tools that you should be using with your lender. Doesn't have to be Franklin. I'm not here promoting Franklin. I'm here to educate and add value. And if you want to work with a Franklin loan representative, they can do this for you. Please reach out. I'd be more than happy to help. But these are the challenges. Not me, by the way. I got a great team of people, and I reach out to them. And if you have a relationship with me, so be it. But I'm here to support this community and my company. And these are the challenges. The realtor challenges will become opportunities. Reluctant to give up low rate and move up? hesitance for buyers to pay over ask, waiting for rates to come down, and clients' fear of a housing bubble. I know all of you agents can relate to those 4 things because those are basically the 4 reasons why someone's reluctant to buy or sell, move forward. They don't, these are the reasons. Okay. Well, what can the mortgage community do for you to help get some of these buyers and sellers moving forward? Well, I love to say when your emotions are high, your wisdom is low. So when your emotions would be low, then your wisdom must be high, right? So the goal we need to do is get people's emotions down by educating them, giving them market perspective, giving them a blueprint, a plan of action, put the breadcrumbs down. Say, yeah, you might not like the rate today, okay, but you're not going to like the price at home either here. So you have to talk through why it's important for them to buy right now. And so there's 4 real tools that we're using. I put a star here because I'm not going to talk about that consolidation tool today, but I am going to spend maybe the next 5-7 minutes going through a bid over ask tool that we can provide for you to get you the emotions low for your client, a rent versus buy tool, which is super powerful, been around forever, but if done right, it's probably the most effective tool to get people out of being a renter mindset to a buyer. So we'll talk about that. And then a cost of waiting flyer, why you shouldn't so much. I'm going to wait 2 years, I'll get a better deal. Well, okay, there's always an opportunity for a better deal, but those are hard to find sometimes. And you might have to go to a property that's not livable. You might have to go to a different market. There's reasons why you're going to get a better deal. But if you're looking to buy in a certain market, looking to be in a certain place, these 3 tools will help. So let's just dive right into these tools. This is our bid over ask price. I went in and put a real property from Riverside, California. Okay. And the overview of this is that the list price says loan amount. The list price is $670,000. And for a buyer to be able to buy it, they have to bid $10,000 over the list price and they got to pay $680,000. Well, there are statistics on this. And if we go back 63 years and we average what real estate values have done in Riverside County, okay, it's gone up 5.18% a year. So I'm going to go off 63 historical average. I showed you guys, don't bet against the champ. Real estate goes up. Okay, so based on a 5-year forecast, if someone was to buy this home over 5 years, they're going to gain $182,000. Okay. Well, that sounds great, right? But they're like, I got to pay $10,000 more. But then if I'm going to make $182,000, it should be a no-brainer. So here's a better visual for individuals. So here's today. This is what the house is worth. The little shaded area is what they have to pay over that price to be able to buy it. But look what happens 1 year later. This little shaded line here, that's what they ended up paying. And within 1 year, they've already made a bunch of money on this home. And within 2 years, more equity. In 3 years, even more equity. In 4 years, even more equity. In 5 years. And this doesn't even take into account amortization gain. This is just real estate appreciation. And I'm going to explain to you what I mean by amortization gain in a minute. So this bid over ask tool is a very great tool to lower the emotions. Take a deep breath. This isn't the school zone you want. It's in the city you want. It's next to your friends. It's got the square footage and the bedroom count you want. They just need to be told it's okay to pay overvalue if it's the home you want and the place you want, because it's going to go up over time. You get your money back and you get it back very, very quickly. You're not waiting 8 years to get it back. A second tool I talked about was buying versus renting. There are so many false articles out there that put the scare tactics into people to only rent. Matter of fact, I don't know if you know this, but right now, 27% of every transaction for buying real estate in the country is first-time home buyer. Okay. Now, check this out. If you were to strip out cash from all the transactions, first-time home buyers account for 49% of every transaction for someone buying a home. 49%, 27 if you include cash. Obviously, a lot of first-time home buyers don't have cash. So the reason why this is so expensive is because there's a lot of people out there say, I'm better off renting. Well, you're never better off renting. And here, I'll give you an example. This is buying a $700,000 home. It's at an interest rate of 8% with fees. So I have the interest rate in here, the APR, okay? And I put in here property taxes. I put in maintenance and repairs, which is HOA. And then I put in here, we've also got a calculator that tells us what the average rent price is for a $700,000 home in Riverside County. And that's around $4,450. Okay. And then you've got renter's insurance, $65. So right out of the gate, a renter is going to save $2,000 right here, almost $2,000 the rent in cash flow. Okay, so if they look at the cash flow over the next 9 years, the renter's right. They have to spend $70,000 more to pay for their mortgage, their property taxes, their insurance, their HOA, and this is all they focus on. But there's some other things you need to look at, and that is the appreciation gain. I already talked to you about appreciation in Riverside, about 5.15% over the last 6 years on average. So if the home started at $700,000 and appreciated at 5%, 9 years would be worth $1.1 million. Okay, so you get $400,000 appreciation, but that's not it. This is the number that no one wants to give credit to. All of those 9 years, when they made their payment for principal and interest is the majority of the payment, but there's still money going towards principal. Depending if it's a 30-year fix, 15-year fix, and the shorter the amortization, the more it goes to principal. But on a 30-year fix after 9 years, they would have put $66,000 back into their pocket because they paid their mortgage down. I said they put down 10% on $700,000, so they started with $630,000. Now they've got a mortgage of $563,000. So they made these two numbers, right? Well, what about if they sell it? They got costs to sell that home. Okay, so the cost to sell them, let's say it's 6% of $1.1 million. They get a $66,000 cost to sell that home. Okay, we're going to take that into consideration here. But if you're going to take everything in consideration, you got to give them the tax benefit of buying a home. And you can write up of the $900,000 on a primary residence. So if they have a mortgage of $630,000, they can write it all off. So I assume the standard deduction, which is conservative for a husband and wife, in a 22% tax bracket. Well, guess what? If I do that, here's what these renters should be seeing. In 9 years from now, they would be $376,000 wealthier in net worth. Okay. They wouldn't, if they bought a home in 1 year and left, they would have lost $19,000. So renting is great for short-term perspective of 1 year less. But I wouldn't even say renting is great for 2 years, because in the second year, you've made money. Third year, you made money. Fourth year. And once again, I'm taking closing costs into these numbers. I didn't even tell you that. I'm taking obviously the cash flow difference, the cost to sell these. Okay. I'm taking all that in consideration. So this is a very thorough observation that will lower the emotions of someone who thinks they need to rent because they read some stupid article that tells them renting is better than buying in today's market. All right. The last tool that's very helpful that will lower the emotions of buyers and sellers, and maybe even your emotions, and maybe this is information you need to hear, is the cost of waiting. Well, you know what? My neighbor said I should wait a year, I'll get a better deal. Or, my grandfather said I should wait a year, I'll get a better deal. Or wait 2 years, the market's going to come down. Or, I'm going to wait 3. For sure it'll happen in 3 years. Well, let's imagine the same scenario. Buying a home, Riverside County. I did this for Market Watch. Property's worth $700,000 based on a 5% gain. In 6 months from now, half of that 5% you would have gained. Now, if you wait in 6 months to buy, you're paying $717,000, 2.5% more. You wait a year, you're paying 7% more. You wait 2 years, you're paying 12% more. So the only advantage in this situation for waiting, which I take into these numbers, is 8% is the rate today. And I think rates are going to be 7.5, 7. I actually put these at 7. I think rates here are going to be closer to 6 to 5.5%. And so there could be an advantage to wait for rate, but you can always refinance and get the lower rate. But if you wait 3 years, say, okay, I waited and I got 5.5. I'm so smart. I would have had 8. Well, yeah, but now you're going to pay $822,000, 17% premium to buy that home. Well, that's just silly. So here's an analogy for you. If you waited 6 months to buy a home because your neighbor said to wait, you lose $20,000 net worth. If you wait 1 year, you lose $55,000. If you wait 3 years, you lost $140,000. These numbers don't lie. And these are the facts. These are the breadcrumbs. This is the blueprint. This is the information that the real estate community needs to be getting out to their buyers and sellers to lower those emotions, because it will work, and then they will make decisions that are wise decisions and not making them based on fear, because we already know fear is false evidence appearing real. And when you're fearful, you should face everything and rise and do the opposite of what the fear is telling you. So on that note, I want to go through a summary of my presentation. I hope this was helpful today. And for those of you who were not able to make this, obviously, if you're watching this, you're not making the live presentation on Tuesday. Hopefully you can make the next one. So inflation will continue to ease, and we'll hit the Fed's target rate of 2% in 2024. I'm very confident of that. The Fed is likely done raising rates. They will most likely cut rates in 2024. They are meeting again in 2023, December 13th and 14th. 95% of people think they will keep rates neutral and not touch them. Obviously, everything's data dependent. If something were to occur between now and then, things could change. But with unemployment numbers coming out poorly, gasoline prices coming down, a lot of these things are pointing towards inflation cooling, which is a great sign. Interest rates will follow inflation lower, okay, and they won't follow inflation as low as we would like because of the things we talked about. But as soon as that spread between the 10-year Treasury, okay, and the Fed funds rate and the mortgage rates, they come back to natural 2% levels. That'll be a huge pickup, and we'll have a refi boom. So I'm going to be conservative and say rates will be 6% in 2024. I think they're going to be better. I think they'll have 5 in front of it. I also expect the Fed to start cutting interest rates by the June meeting of next year of 2024, which is also a good thing for credit card payments, car loans, interest rates, and getting more inventory to the market. High probability of recession 2024. I don't know how anyone can argue that point. I outlined it. We've never seen every single trigger activate and hit. A recession's coming like intimate, next couple months, or we're already in it. Time will tell, but they don't call them when you're in them. They call them when you're out of them. And so if you're waiting for them to tell you in a recession, it's too late. We're already out of it. Real estate will continue to appreciate on low inventory. I see real estate appreciating at a more modest level in 2024. I'm expecting 2 to 3% increase, not the things we've been seeing like 6 to 8 or 10 or 11. Real estate values will continue to appreciate, but at a more modest pace. And expect buyer and seller activity to increase with lower rates. Everyone's talking about it. There's pent up demand. People love to sell. They'd love to move. These get high interest rates. They're nervous about the economy in the market, in the stock market. Those things will ease with inflation coming down, with the Fed cutting rates, with interest rates coming down. And if you guys can get out there and share this good news and start educating the buyers and sellers as much as you can, like I said, we'll do our best helping with the things we can do. We can lower the emotions of the general public. We can support them to really look and analyze buying real estate. And when they do, I think they're going to see the same things you and I see, that buying real estate is always a good decision, especially as a primary. I'm not saying a second home makes sense for everyone. I'm not even saying investment property makes sense for everybody. But I do believe it's an owner-occupied home, first-time home buyer, second-time home buyer, just changing homes. I think it's a no-brainer to buy real estate. So on that news, I want to thank you all for joining the fall webinar seminar. I hope this was helpful. I think I got about 30 hours into this. I put these slides together. This is all my data. And I think someone asked me last week, that's why I'm telling you this. They go, Palm Springs Lights really gives you great data to talk about. I'm like, you thought they put my slides together? I'm like, no, this is all that's something that's a little bit of a passion, but it takes a lot of time and energy. So I hope you all enjoyed it. I look forward to seeing you all at the next Market Watch in person, which I believe is February. Just look out for the information on that. Mike, amazing job, Palm Springs Life. Thank you for hosting this and putting this together. And I hope this was all valuable. Please reach out to anyone at Franklin Loan Center for any questions, concerns, feedback you have from this presentation. And if you want the slides, reach out to us as well. We can help you with that. God bless you all. Bye-bye.